Hi, welcome to Market Minute. Hey, did you see the Colorado Buffaloes play over the weekend? They had that against Baylor. They had that Hail Mary to right at the end of the game to send it in overtime. What a play! Love college football. So big shift in Fed policy. So we're going to talk about what that means. So how can we take advantage of this, right? So we really like the equity income space to play off the Fed policy change. And then we're going to review the valuations of the stock market and where the opportunities are. So what happened last week with the Federal Reserve policy change? We find it kind of odd that the stock market in general is at a very high valuation. Haven't had a major correction. Well, we did, I guess, in 2022, but haven't had a major correction, leaving the yield curve inverted for the longest period in history. So I'm going to explain to you why the market's not freaked out about it, and that change is coming. But the Federal Reserve did what they needed to do. They delivered. So they cut 50 basis points. They changed their outlook considerably. Okay, the big change was dropping the federal funds rate from 5.1 is what they had back in June as an expectation for this year. That went to 4.4, and then next year it went from 4.1 to 3.4. So that's a big drop. It's about 200 basis points shift in policy. So, it's going to have a big impact on certain sectors of the market. So just in general, though, this is somewhat confusing um, as to what the Fed's expecting. They expect a 2% GDP growth rate for as long as I can see, and then unemployment to ratchet up a little bit. So unemployment going the wrong direction, and that inflation to basically remain stable at or close to 2% over that time period as well. So what is really happening? So we believe the federal government is really supporting the overall economy. It's accounting for probably at least half of the real GDP growth. So $793 billion increase in spending by the federal government versus a year ago in the past 11 months. So that equates to about 2.9% additional nominal GDP growth. That's crazy, right? So it's comprising about half the real GDP growth. The real economy, the private sector really isn't growing very much. And I don't think the market is really realizing this. And I think maybe the Federal Reserve is starting to realize that and is having to take action, because this sort of growth in the federal spending is not going to last much longer. So in August, guess what? We're in election year. The federal spending went up 30% from the prior months. So one is at an elevated level, but it went up even more in the month of August. Yet in 9 of 12 regions, we saw negative growth by the private sector. So the key policy shift of dropping interest rates quite a bit, yet not rekindling inflation or spurring higher GDP numbers. The only way to explain this is that the federal government spending is going to shrink, and shrink by maybe quite a lot, and the timing is somewhat tricky. So if you look at this chart here, this is the 2-year Treasury, came down to 3.6% from 5. So the Federal Reserve is looking for 3.4. So we're basically have on the yield curve. So in the bond market and in parts of the equity market, we are discounting what the Federal Reserve is saying that what they're going to do over the next 12 months or more. So the implications. So if you need income, you need to start moving your money. Granted, there might be a drop in the overall stock market, so maybe dollar cost average your way into this. But if you need income, you have your money in short-term rates or CDs, in money market funds, you're going to see a 2 handle on those funds probably over the next 12 months. So currently at 5%, you can get 5%, that's moving to 2. So if you need that income, you got to get into these equity income strategies that I think are really compelling right now. And then this is another really important point. So the Federal Reserve cuts interest rates uh, by quite a bit. We still have GDP growth of 2%, and the inflation target is still 2%. So the 2%, the big drop in interest rates, basically is not going to have any sort of impact on the economy according to the Federal Reserve. So if the Federal Reserve is able to pull this off, we see a lot of transition in the overall equity markets. Probably the federal government spending comes down in a big way, allows the private sector to grow, so that as the federal spending comes down, it has a negative impact on GDP, and yet at the same time, the private sector grows. So this is really good for small cap stocks, value stocks, and equity income stocks. So in terms of wealth management, so we really like the equity income stocks, right? So I want to show you this top chart here. So the green is the S&P 500. The gold is the S&P 500 high dividend, SPYD. So it has underperformed, SPYD has underperformed the S&P 500 by 53% over the last 5 years. That's a major underperformance. Usually it doesn't happen. Obviously, the technology stocks are driving this outperformance, but we think there's a catch-up to occur. Now, this may already be starting to happen. So the green is the S&P 500 the last 6 months, and the gold is the high dividend paying stocks. The high dividend paying stocks have outperformed this short period of time by 6.5%. We think in general, if you really do your homework, you can get 8 to 10% sort of yields on good, high quality equity stocks. So you gotta go for these higher dividend paying stocks, and the blue chips are between 4 and 6% as well. So there's good yields there. But if you know what you're doing, you can really find these really attractive higher dividend paying stocks. And this is a strategy that we focus on quite a bit. So if you need income, start to think about this, and we're happy to help. Valuations. So this is very concerning. So no matter how you slice it, the valuations look high. So if you take out the COVID implications that occurred, we're at a all-time high over the past 10 years. So the high in the past 10 years in terms of PEs of roughly 21 times forward multiples and 23.6 times the current 2024. We are getting to the end of 2024, so it's time to start looking at 2025. 2021 is very high for evaluation. You can see over time, over this past 10 years, it really hasn't maintained anything much above 19 times PE multiple. So, okay, maybe that's not the best of indicators for valuation. We think it's a good one, but maybe not a best of indicators. So, who's the smartest guy out there? Warren Buffett, right? So the Buffett indicator, market cap to GDP. So we're at 200% market cap. So that's a Wilshire 5000 to GDP. So that's a really high valuation. You go all the way back to the year 2000, we're at 140%. So on that matrix, we're a lot higher than what they were in the 2000 because of this massive concentration into these large cap technology stocks. The Shiller PE, okay, this is kind of interesting. It's a weird methodology to do valuations, but we think it has some applications to look at valuation over a long period of time. So it basically takes a 10-year moving average of earnings and then adjusts for inflation. So you can go back, like I mentioned, over a number of different decades and look at the valuations. So the Shiller PE, so it's not as quite as high as it was in the year 2000, where it was close to 45 times earnings. Now it's at 37, and it was 31 times right before the crash in 1929. So this chart is somewhat disturbing if you see that the significant decline just to get back to a normal range of 17 times earnings for the for the overall S&P 500 adjusted for the Shiller PE. Okay, so where's the opportunity? All right, we mentioned equity income. We like that a lot. We think that's a no-brainer. Okay, as rates come down, those stocks are going to perform very nicely. Um, and we think that the S&P 500 is already valued where it should be. We see very minimal upside in terms of the PE for the overall markets. So we could see the markets go higher if there's good earnings growth next year, if we can maintain the current valuations of the overall markets. So we do have the Fed cutting rates. That should help. As I mentioned, it's probably already in the stock market to a great degree at this point. So what's not in the markets, right? Where's the valuation? So if you go all the way back to say 2012, and this is the start of this big bull market in large cap stocks, the mid caps in green, the mid caps in blue and the small caps in green, they traded at a much higher valuation than the overall stock market versus the S&P. And so if you look back at this over time, they've consistently traded at higher valuations. So if it's possible for the small and mid-cap stocks to trade at a higher valuation than the S&P 500, there's a massive move in these names here. So we like these stocks going forward as interest rates kind of come back down to more reasonable levels. The money's going to move around quite a bit. So equity income, small cap, mid cap should perform fairly well, but really like the equity income stocks. So if you have any questions about this, come to my website, Patrick Adams, CFA. Send me a question from the website. Also, sign up for a hard copy of Market in a Minute. We'll send that to you every week. Thank you very much.